monetary system works. One party has assets, they make loans, same side of their balance sheet actually, they make loans, but they issue liabilities, that is deposits, on the other side of their balance sheet, the liability. That's what these green items are. Okay, so in order to see some leverage of the system, we can run multiples. So how would we do something like an M1 multiplier, but it's the sacred multiplier. If you're an Austrian, it's demand deposits divided by bank reserves. Okay, so it's M1 minus M0 divided by bank reserves. Let's put this multiple up. It's gonna be on the right-hand side now. What we can see pre-GFC is something that it looks kind of wobbly, but if you look at the right-hand axis, it's not too much. All right, in the 80s, you got a multiple of 14x. In 1995, you got to a low of 8x. And then just before the GFC, you got up to about 12x. Okay, I'll take the cursor off so you can see back into the 60s as well. 13, 12, 10, 14. This is the inverse of the reserve ratio. If you read a lot of Austrian papers or articles, you hear the reserve ratio is commonly 10%. That's just a number they put out. It's not actually necessarily that at all, as you can see in this chart. Reserve ratio actually in the United States doesn't even exist since COVID. They completely removed it. Before that, the large banks, the city banks, the Wall Street banks, they had to have a reserve of 10% or more. The old country banks, the rural banks, they didn't have a reserve ratio at all. And different countries have different ratios. One thing here, interestingly, all right, and this is why I don't put much faith in the dangers of fractional reserve banking. I put faith in the dangers of central banking, but that's very different from the dangers of fractional reserve banking. Is notice that this is the whole chart in the United States monetary system of those very basic deposits, demand deposits, cash, and it doesn't look crazy, okay? And to be clear, lower is better. Lower is less leverage. So, in the 90s, on the eve of the World Wide Web becoming popular, we were in a very safe place. Only 8x leverage of demand deposits over bank reserves. And again, what is that bank reserve? It's just vault cash if people want to make a run on the bank. And that's a very small component, right? That's like 5% of that multiple. The vast majority of that multiple is just a electronic balance at the Federal Reserve, a ledger entry at the Federal Reserve. It has the same legal statutory requirement. It's analogous. Any bank at any moment can say, hey, Fed, we need more cash over here. Give us cash. And they can swap out their bank reserves for cash. But that's how it works. Notice that even though, it does rise as we get towards the GFC, it rises from 8x to 12x. It's not like that was an all-time high. It's not like we necessarily know that was a breaking point. So my point is there's more to what's happening in the system than just the sacred demand deposit, okay? But as they do, Ben Bernanke, with all of his liquidity and his bailouts in 2008, he made the system even more complicated and more unanalogous to the past by putting these massive amounts of reserves into the system, okay? It was a crazy move. It zombified banks, bailed out bad investments from money market funds, hedge funds, and banks. So now we have this completely unanalogous move of going from, something that makes sense of a reserve ratio, 11x, whatever, for demand deposits, down to almost fully collateralized. Understand that. Theoretically safe, but of course we don't believe it's safe. That's why we like Bitcoin. But it's just a nonsense thing to do. This is just pure zombification. This is zombification of banks, what you see here. So now, instead of being only 10%, right, what's 1 divided by 10 or 1 divided by 11, right, closer to 10% or 9 or 10% reserve ratio, we're at 100% reserve ratio here, post-GFC. It's pretty nuts. We've gotten some of the leverage back. Some of these bank reserves have flown out of the system, but it's not anything to ride home about as far as a celebration or a return to normalcy. Hope you're finding these videos creative and to the point when it comes to navigating the rough waters of the financial system. And I'm happy to share with you a platform that can do the same when it comes to getting a loan secured by your Bitcoin, and that is Debify. Debify is a non-custodial, Bitcoin-backed lending platform designed for people who want to borrow against their Bitcoin while maintaining full control. Debify offers institutional-grade liquidity through independent lenders, allowing for high-volume loans of up to 5 years. All transactions are secured by a unique multi-sig escrow system, ensuring that Bitcoin collateral remains safe and transparent. This setup guarantees that your Bitcoin is not rehypothecated, and you keep full visibility and control throughout the loan process. It's perfect for those who value security and transparency while exploring global stablecoin and fiat lending backed by Bitcoin. So head on over to debify.com today to get started. It's just not normal banking still. We're only at 2x. Okay, so we have this huge pile of reserves sitting in banks as an asset for banks, and they're not loaning them out. Okay. So that's odd. It's a problem. The Federal Reserve, of course, George Selgin has written about this a lot. The Federal Reserve has discouraged the loaning of these reserves precisely because they were afraid of the inflationary effects, and they started to pay interest. They had started to do something completely abnormal during this period, and I'll show interest rates in a future video, but they started to pay interest on these reserves. So if you're a bank, typically right during these periods, right, the Fed funds, I'm looking at the black vault area, the vault cash and the bank reserves. Banks got no interest on those things, typically, back in the day. So that's why they would swap out reserves for other loans, for assets, loans to their depositors. So they would increase the deposit base generally. And by the way, that's not all bad. Okay, this is banking. This is how things scale. Populations grow. Suspend your belief about Bitcoin, which I share for a second. But this is just, banks have always expanded the deposit base this way. It's not abnormal thing. It's not an abnormal thing to do. Clearly, just to make the point, you cannot look at this chart pre-GFC and say there's something systemically wrong with this. How did all this happen post-GFC? You have to go farther up in the monetary stack. And that's where you see it if you put in M3.